business leadership.
Welcome back to Bazaar Morning Call. Well, we're a few minutes away from market opening and Anuj joins us in the studio. Anuj, it's going to be a long day. We have market action, editors roundtable, then the FIFA games as well. But first up, let's focus on how to address the markets. Gap up is what we're bracing for.
You know, we are bracing for perhaps the best sporting action ever over the weekend. I think some really great games lined up, and Saturday night I've made my plans, 2 great matches. I'm going to watch both of them with my friends. So I think it's not something to miss.
Who are you going with, but?
France, obviously. I think France, just too strong a team. And
tonight?
I think maybe Netherlands. I think Argentina is too overhyped, and Netherlands is something which has been very close to my heart for long. You know, I've always thought that they're the best team to never win the World Cup. Ever since the time of Ruud Gullit and Ruud van Nistelrooy and Robin van Persie and Arjen Robben.
Always had the players, but never could win the World Cup.
Always had the players somehow. They came very close in 2010 when,
Spain.
Robben should have scored. But anyway, these things happen.
And Brazil you're going with as well.
Yeah, Brazil. Obviously, Brazil. I think most Indians go with Brazil. Right?
So, okay.
But anyway, on the market, I think, Nigel, what clearly happened in our market is we latched on to crude. That was the big trade yesterday. The Bank Nifty hit all-time high. That was an algo trade which played out. It's clearly the leader for the market once again. But we need support from IT or Reliance for Nifty to move up because the banks can only support this much, right? The global cues are again positive this morning, though FI selling continues. And keep an eye on China as well over the next few days. On the Nifty, what I've noticed is huge call build-up between 18,600 to 18,800. So there could be some profit booking between 18,750 to 18,800 or 18,700 to 750. If you take out 18,750, perhaps maybe another try at all-time highs possible. Sector to watch today for me would be FMCG and autos. Normally they do well when crude oil prices fall. On the Bank Nifty, we started a fresh expansion, but going by the options data, my sense is today after the gap up, you might see some profit taking between 43,900 to 44,000. But this is an index where every small dip consolidation is being used to buy, but overall remains the stronger index.
Okay, thanks a lot, Anuj, for that. Well, in pre-opening, a couple of stocks do deserve mention, and the pre-opening rates are settling. It's HCL Tech that's your top loser right now, down almost about 2% as the company has mid-quarter scaled down their revenue guidance, and that's something that the street has not liked. HUL is holding up on the back of the Oziva acquisition that they made, so keep an eye out on that. And would be very interesting, I haven't seen the pre-opening rate on Paytm, but would be very interesting to see the market feedback or the market reaction on the announcement of the buyback. Paytm up almost about 8.5% now. So definitely something that the street is going in with in green. Let's see how the day progresses there. But Manoj Muralidharan, the Vice President Derivatives at Religare Broking, is with us. Manoj, good morning. Your thoughts on the index? It's going to be a green start, at least for now. But do you think we can build on to our gains? And what are the individual stocks to look at?
Good morning, Sonia. Sonia, I guess yesterday, the expiry, at least in the last 1 hour, we saw that the Bank Nifty pile up a lot of long position, and that has been carried. So usually we saw this, the last time was just a day before the RBI policy, but the next day it fizzled out. So there is a term called as a volatility crash which happens in the market. So if you see the IVs for the Nifty has also come down to almost 12%. This usually had a pivot or a break even somewhere close to 14%. So what generally happens in a volatility crash is we see a sudden surge in the index, and that usually happens for, let's say, a 0.25 standard deviation. So that's somewhere close to 200 to 250 points. So I believe that now that the base at 18,600, Nifty might make a newer high closer to 18,900 in this possible 15 December expiry, and that would be banked or backed with the Bank Nifty towards a 44,200. So the trade here is you go long on the Nifty at 18,600, keep a stop loss 18,500. The target is 18,900 on that. You can use an future or maybe a 15 December at the money call option. But the momentum would be more on the banking stocks or the Bank Nifty, with 43,560 as a support for the day possible. That is a level you could go long, keep a 200-point stop loss, and the target can be a good 700 points in the upside, a 44,200 on that.
Okay. All right, Manoj, what about stocks though?
Nigel, hi, good morning. Nigel, I like Axis Bank because the stock has seen good buying at least in the last couple of days. So we believe that 933 is a good level. Even with the futures, you can go long with the 927 at the stop loss. And the target can be a good 915 to 952 on that. Tata Motors, if you remember, right from October, series has been in the range of 390 to 420. And we believe this is a good level to go long. The stock has a potential of 25 more points on the upside with 450 as a target. You can choose a 420 call option as well to buy closer to 2 to 3 rupees. The target can be a good 8 to 9 rupees.
Okay, Manoj, thanks a lot for joining in and giving us all of those cues. Well, for now, the pre-opening rates are settling very quiet, really, not too much happening on the headline index. The Nifty gainers include names like BPCL, SBI Life, Wipro and HUL. While on the losing side, HCL Tech, of course, is your top loser, down almost about 2.5%. But let's get our favorite Momentumizer segment, where we talk about stocks that have some amount of momentum going both on price and volume action and some reasons behind it. Star Cement is the stock on our radar. Surbi has more on that. Surbi, over to you.
Today we will be focusing on Star Cement. The current market price is 118 and just yesterday the stock was up 5%, and in the last 6 months the stock has gained over 30%. It is close to its 52-week high of 120 rupees and comfortably above its 50, 100 and 200-day moving average. The stock has been traded close to 7 times its 5-week average this week, and the delivery quantity also has been strong. It's been 5 times the 5-week average this week. Now, a little about the company. It is a prominent cement company with operations in the east of India with close to 23% market share in the northeast. It has a cement capacity of 5.7 million tons per annum and a clinker capacity of nearly 2.8 million tons per annum. A few key triggers that could go in the company's favor is that they have guided for a strong volume growth of 20% for FY23 and also planned a capex of close to 2,200 crores in the next 5 years. So all of this could work in the favor of Star Cement.
Okay, that's on our Momentumizers list. Surbi, thanks a lot for that. But let's move on. It's a largely disappointing year for Indian pharma companies when it comes to inspections by the US drug regulator. There's been an OIA status on Sun Pharma's Halol unit and Cipla's Goa unit as well. The US FDA has also escalated action against Glenmark, Lupin and Aurobindo Pharma. To discuss the implications of these regulatory woes, Vishal Manchanda, the pharma analyst at Systematic Groups, joins us now. Vishal, do you see this underperformance continue for the pharma companies because of the strict action that the US FDA is taking, especially in the last many months? What could the repercussions be and what do investors do right now?
This has been very unfortunate for the industry. So many warning letters, and this import alert was entirely unexpected. So we have been in a remediation phase as an industry for the last several years. And despite all those efforts, we are still seeing plants getting into warning letter, and import alert was entirely unexpected. So I think this should certainly be an overhang on companies because we still remain most large companies remain 30 to 40% dependent on their sales from the US markets. So I think, I don't know when this will stop. This was, so it was expected the compliance issues should subside. We should be in a better position as of now with so much of remediation and improvement happening over the decade. So let's see how it pans out. But certainly we are largely dependent on US 30 to 40% of sales for most large cap companies.
Okay, all right. Hi, Vishal. Morning. Nigel on this side. Vishal, since things are a little bit cloudy, how do you approach the sector? One was thinking that maybe the worst of price erosion is behind. Now suddenly you have these, US FDA visits and other regulatory hurdles. Your approach to the sector and what's your top buy?
So with the regulatory overhangs facing most companies, I think the cleanest one among the names is right now is Zydus Life Sciences. So that doesn't have any facility under warning letter as of now, but most other names, say Cipla or even Lupin has got multiple sites under warning letter. Dr. Reddy's also has a clean slate as of now. They don't have any large site facing compliance issues. But the point on Dr. Reddy's is they face this overhang around Revlimid litigation. So they have this large product Revlimid that's expected to contribute a lot over the next 3 years. But there's the litigation around that, which should potentially be an overhang on the stock. So we don't have a coverage on Zydus Life Sciences, but that appears to be a cleaner name at this point in time to own.
Okay. Any companies that you feel could see the biggest impact of this pricing pressure in the US, supply side challenges? There are, of course, the margins across the board are expected to move lower as we head into the new year. But which are the companies that could see, incremental weakness from here on the earnings front?
So I think from an earnings point of view, I think so Sun Pharma should, despite the Halol import alert, I think they should continue to progressively improve earnings. Probably there would be a dip, maybe in Q1 of FY24, we'll see a dip, but earnings should progress favorably. Most companies would have their earnings moving favorably. So Revlimid would be one of the key drivers that would be driving earnings for the companies. Only if there is a litigation going against the Revlimid settlement, we might see earning pressure again taking over companies. So even from a raw material perspective, which has been impacting companies over the last 1 or 2 years, raw materials have started to move favorably in terms of pricing. So the basic raw material prices have started to come down. Freight costs are normalizing. From a margin perspective, I think things look better. Pricing pressure in the US, that's something we always expect to stop. So kind of we always expect the pricing pressure should reduce. But we really don't know when we'll see that inflection point and pricing improving from where it is today. So I think at prices where they are today, most companies who sell in the oral solids in the US are not making ROCs above 10%. So they are all below 10%. So my sense is they should start improving.
All right. Thanks very much for that, Vishal. Appreciate you joining in. That's very stock-specific views which are coming in. But it's 9:10, 5 minutes to go for the market opening. Mitesh is here to run us through his 9:10 calls. Mitesh, hi.
Yeah. Prashant, I'll go with the buy call on Bharat Forge with a stop at 859 for targets of 900.
Okay, I'm glad you brought that up because Bharat Forge is a stock that will be in focus today. There's an analyst meet that's taking place. The management will be addressing analysts. And yesterday, Bharat Forge spoke to CNBC-TV18 where they did talk about big orders in the defense space, especially with artillery guns in Europe. So that's a stock that perhaps could be trending higher this morning as well. But IT is the big sector in focus, especially after HCL Tech scaled down their guidance. Rima's here to tell us more. Rima.
Thanks so much for that. So today, Credit Suisse has written that they believe there is a high risk that Indian IT companies will see revenue downgrades in FY24 if the US growth declines from here on. If there are further cuts in the US GDP estimates, then there is a risk that Indian IT companies' top-line growth will get affected negatively in FY24. So they're modeling in close to a 2 to 4% EPS cut for the Indian IT companies, driven by a decline in the top line to the tune of about 2%. They also go on to say, but stock price is dependent. The correction in stock price is more dependent on valuation derating rather than EPS cuts. So while the EPS cuts may be just about 2 to 4%, they expect a higher valuation derating. They're saying the Indian IT companies trade at a 34% premium to the pre-COVID average, which is much higher than the valuation premium the other sectors enjoy. So they see HCL Tech at a high risk of 20% plus valuation correction, of 15% valuation correction for Infosys and Wipro, and about 8% for TCS. They say it's time to be selective on the sector. They like Infosys because it has a higher growth rate versus the other peers. Neutral on TCS and HCL Tech, underperform on Wipro. But on an average, they're saying it's possible that the top 4 IT names could fall 10 to 27% if the US macro worsens from here on. Back to you.
Okay, all right. Rima, thanks a lot for that. Well, let's hop across to Sonal. She's here to tell us about the OMCs. Remember, crude oil prices continue to head south. Sonal?
Good morning, Nigel. Well, yes, that's a positive for oil marketing companies. We are seeing that crude oil prices are below that $77 per barrel mark, and a couple of reasons why that has happened. G7 prices have been capped at $60 per barrel, that is for Russian crude. European Union has curbed Russian oil imports as well, and also we are seeing building up of inventories in the US markets as well. All of this leading to some pressure on crude prices as well, and that is something which is positive for oil marketing companies. In the refining segment, refining cracks now they are higher at $11.4 to $14 per barrel, which is comparing to around $4 to $5 per barrel in the quarter gone by, and this is driven by increase in spreads both on the petrol and the diesel side. Diesel spreads, which were under some pressure, have risen by $4.6 per barrel. There is strength in petrol spreads as well. And in the marketing segment, yes, there is still some losses for the diesel segment, but those losses have narrowed to 10.6 rupees per litre versus 13.2 rupees per litre, while petrol spreads, they have strengthened further to the likes of 8 rupees per litre. So both in the refining and in the marketing segment, we are seeing some gains coming in for these marketing companies. ICICI Securities has done some some analysis as well, where they say this could lead to an improvement in their marketing segment, and that is the reason why EPS for these companies could increase in the second half, leading to lower losses than what they saw in the first half. Okay, thanks a lot for that. Well, Paytm, of course, is the other stock on our radar. It's up 7% as the buyback announcement has perhaps instilled some confidence in shareholders. But will that last? Abhishek is here to give us the details, the fine print on Paytm. Abhishek.
Well, to begin with, they are holding a buyback board meet on 13th of December. Just to alert our viewers, the cash and cash equivalent in the balance sheet is around 9,182 crores as of Q2. As of Q1, it was 9,411 crore, and in FY22, it was around 9,271 crore. This also includes proceeds from the IPO that they have, about 8,300 crore of fresh sale that they did in the IPO. So the net worth is around 13,500 odd crores. SEBI rule says that on the maximum side, you can have 25% of the net worth, which could be considered for buyback under tender route, and 15% via open market. Back to you.
All right, Abhishek, thanks very much for that. We're just, a couple of seconds away from market opening.
Absolutely. So, the initial tick right on the index is well in the green, up almost about 0.2%. And it's led a lot by some of these banks yet again. So, no surprises there. The Bank Nifty is up about 120 odd points. IndusInd Bank, Kotak Mahindra Bank are the big gainers at the moment, up about 1 odd percent. Tata Steel is your big gainer on the index, up about 1% as well. HCL, on the back of that acquisition, is up almost about 0.7%. BPCL, HDFC Life, and a lot of the auto stocks are doing well this morning after the FADA data. The Federation of Automobile Dealers Association came out with the numbers for the month of November, and it's looking good. It's a double-digit growth that we're seeing in retail sales across the board. M&M, Eicher Motors, Maruti Suzuki are not too bad, up almost about 0.5% to 1%. On the downside, HCL Tech is your sole loser, down almost about 4 odd percent. But stripped of that, there are not too many losers in trade today. ONGC, Tech Mahindra, ICICI Bank just trending on flat line. Apart from HCL Tech, the market actually is in fine fettle. Paytm is the other stock. Of course, we'll talk in greater detail about that, but 6% higher on Paytm as the board is mulling a buyback. The board meeting will be held very soon, so more details coming through there. But for now, the market opening is in the green, trending higher for the Nifty in line with what the global markets were suggesting. And the market breadth is very healthy this morning, over 1,800 stocks on the advancing side. So, good-looking screen.
Well, that's right. It's a good-looking screen, Sonia. And there are plenty of gainers actually from the broader markets as well. Sonal just told us that oil prices are low. So, that's good news for OMCs. You have HPCL that's up and about. That's one of the big gainers from the F&O stock. So, that one should come up for you in the screen. There's no stock stopping these PSU banking names. PNB, UCO Bank, IOB, you have Central Bank of India, all of them, well, they are flying away in trade today and volumes are rather large out there. Bajaj Consumer, they'll be having their board meet today with regard to the buyback, so keep an eye out on that one as well. Max Financial, well, that one as well has opened up well in the green. And VIP Clothing, well, they are looking to raise some money. Over the last few days, the stock has been moving circuit to circuit. Today as well, the volumes are high on that front. So, a good-looking screen with regard to the broader markets. On the flip side, from the F&O stocks, though, a couple of names that are trading a little bit under some pressure. Manappuram Finance, mildly lower, nothing really to complain out there. But otherwise, a good start. Cummins as well makes it to the list. Stock started more or less flattish in the last minute or so. It's moved up close to around 2%.
Okay, well, a couple of other stocks I do want to mention that have hit fresh 52-week highs. So just want to point them out as well. Yes Bank, by the way, has been moving high up about 2%. But any bank, Central Bank, PNB, IOB, UCO, Bank of Maharashtra, all at fresh 52-week highs right now. Some of these cement stocks are coming back as well. Ambuja Cements is at a fresh 52-week high, and it's had a fairly strong run this year, up almost 57% for the year. Axis Bank, a couple of other stocks. Axis Bank is also at a fresh 52-week high. So is L&T and HUL. So do keep an eye out. Star Cement, by the way, which was a momentumizer, is gaining quite a bit of momentum today, up 3%. So you'd want to catch that segment every day. Amara Raja and Exide are a couple of other stocks that are doing quite well. So all in all, you'd have to say the market is in fine fettle and plenty to pick up, especially in the broader markets. If Mitesh is with us, let's just get a quick comment from him. Mitesh, a lot of heavyweights hitting fresh highs. Okay. Don't have Mitesh.
Let's just look at Paytm very quickly and see what's happening. I think we should be able to come off. I mean, we started higher, but I think it's coming off 4.5%. 528, 529 on Paytm. It's still higher though compared to where it was yesterday. Buyback, of course, to be considered next Tuesday. The size, quantum, the mechanics of it, all of it, of course, is unknown at this stage. But even still, I mean, this is a subject which yields itself to such rich debate on both sides. So it's going to be interesting, one way or the other. Raises so many questions and, of course, generates so many views on what should be done, what is right, should be done, not done, etc. For now, it's up about 4.5%, almost 5% or so. Krishna Kumar Karwar is our market master of the day. He's managing director of MK Global. Mr. Karwar, great to have you with us here. Good morning. If I can ask you to comment on this Paytm buyback subject, and theoretically, how do you think about this? It's a digital company, platform company. Growth is supposed to be pretty strong. And here they are, 1 year after raising money, buying back at this valuation. We don't know, of course, at what price they will decide to buy, but obviously far lower. Your views?
Typically, I think not commenting specifically on any of the companies that you mentioned, but generally buybacks, corporates do indulge in them whenever, obviously, one is they feel that their share is undervalued. Apart from that, obviously, it is always a tax-efficient way of returning money to shareholders. Now, these are the two obvious reasons why we have seen buybacks from companies which are established companies with profits, etc. But as far as platform companies are concerned, I think they have been in this business as a listed entity not more than a year. And their path to profitability, etc. is also not exactly clear, but they are working towards it. And in those circumstances, if any of the companies are thinking of utilizing their cash for buybacks, I think it's a function of their confidence in their business prospects. It's also a question of that they may not require to burn further cash, and hence they believe that buying back shares at current valuations could be more attractive. But on a longer term basis, I think these companies have to deliver profitable growth for investors to value them on a long-term basis. Any buybacks attempted just to give a short-term stability to the stock price may not work very long.
Okay. The stock, in fact, after the initial opening tick has come off a little bit. It's still up about 5%, but let's see, it could be a very volatile run today for that stock. A couple of other names that I want to mention. Capital goods is coming back in a big way. L&T is at a fresh high. Cummins is up almost about 3% right now. A couple of these others like Honeywell have done pretty well lately, so up almost about 2% there. And not just capital goods, but many of these ancillary manufacturing companies are also doing quite well. So that's one pocket that has returned in a big way. For the market, the mid-cap index is the one that's really surging. And once again, no surprises. You have fresh highs on many of these banking names. Krishna, I just wanted to get you in on some of these spaces that are coming back, especially manufacturing, cement. Some of the cement manufacturers told us that both demand and prices have returned to stability, and demand is coming back in a big way. Capital goods, cement, would you add more to your portfolio at a time like this, expecting a big upside?
Yeah, I think the whole manufacturing space from a medium-term perspective looks very interesting. No doubt some of the stocks in the capital goods segment have done well and have appreciated by a reasonably large margin in the last 6 to 9 months. But cement companies, if you look at, I think they have corrected very sharply in the last 6 months. Last quarter was probably the worst for most of the cement companies as far as profitability was concerned. And now what I understand is that yes, high input prices have started moderating and even realizations are improving. So from a medium-term perspective, maybe cement companies should be invested in. There will also be some action in terms of the smaller companies in play in terms of getting merged with the larger companies. So that is also an opportunity. But I think manufacturing as a space, it's not only about capital goods or cement companies, but even otherwise, the auto ancillaries and the likes. I think the whole space is very interesting from a medium-term perspective. It is not only from a India perspective, but also from export opportunities for many of these companies.
Hi, Mr. Karwa. Morning. Since you spoke about the export market and the sector that has maximum global exposure is the IT space. Earlier today, we were covering news that HCL Tech now is guiding to grow at the lower end of what they guided earlier. I recall you telling us that some of the price correction is already in the price, and from here on, you would look at IT more constructively. Do you hold on to that view? And will it be only the large cap names, or are you looking at the mid cap IT names as well?
Definitely. I think there are two ways to look at it. From an institutional perspective, yes, IT companies could be looked at from investing perspective because the prices have corrected and these are huge cash generating companies. So institutions can't time it to the last T. So maybe in the next 2-3 quarters, they would see the business headwinds bottoming out, or maybe that is the reason they should be looked to investing in. From an individual perspective, yeah, I think they can time it slightly better. Let's wait for the quarterly results and guidances, and maybe the headwinds are still there. So have they got into deep value? No, not as yet. Are they fairly valued? Yes, definitely. And between large caps and mid caps, I think whenever there are headwinds in any sector, it is always better to be invested in the large caps because they have the resilience to ride the storm. The mid-cap companies in the sector, until and unless they have some niche products, then they will continue to do well. Otherwise, they will struggle for business. So if there are headwinds in the sector, then the Me Too kind of mid-cap IT companies, I think they could very well be avoided. Their valuations will correct much more sharply than the large-cap companies.
Okay. Just wanted to point out that some of these auto stocks have done a decent jig this morning, so don't lose sight of that. And in the broader markets, you have many of these names. There's Castrol India, there's Honeywell that's in the green, Craftsman Auto, Tube Investments. So many of these auto ancillary companies have also been picking up pace. CEAT is up almost about 2% now, and CEAT has had a 56% run this year on the upside. So it's had a fairly decent showing there. On autos, how are you feeling about the market now, Krishna? Because we were just having a conversation with Maruti where they said that demand is not too bad. Even in the lower end of the market, demand is picked up. Your thoughts here?
So on the passenger vehicle segment, we continue to be positive. I think the cycle has just started and the cycle should continue for a few more years. So we continue to be positive on the passenger vehicle segment. And even the commercial vehicle segment, I think, has started to do better and should do well. As far as auto ancillaries are concerned, yes, they have had a good run. Basis the positive upticks that we are seeing in the main OEMs. And also the export opportunities. I think these export opportunities are going to increase manyfold in the coming years. So we continue to be positive on the passenger vehicle segment, the commercial vehicle segment, and many of the auto ancillaries which have a size and scale not only in the domestic market but also in the overseas market. And as far as tractors are concerned, I think there are some headwinds, but the transformation that many of these companies are going through, and in terms of adding more agri implements and opportunities and export opportunities. So overall, if you look at it, the whole space seems to be very interesting. Yes, the stocks have done well, so you could see some consolidation. But from a medium-term perspective, we should continue to be invested. I am not so bullish on the two-wheeler segment, where I think there is a question of demand itself.
Okay, this question of demand itself. All right, just one word on, of course, we spoke about Paytm particularly, but in general for these platform companies, right, a lot of things are going wrong. Profitability is not back in a big way for most of these companies, barring a Nykaa, which is maybe profitable. But from a long-term investor standpoint, do you find value in any of these stocks, or is it a strict avoid for you?
Some of these platform companies have reached attractive valuations where there is a clear-cut defined leadership. I think those companies should definitely be invested in. And also companies where they have established their leadership, that is one point. And the second is, I think I'm very careful and cautious on fintech companies. I think that is one segment which I believe that the banks, the private sector banks will be able to duplicate whatever technologies, whatever new disruptions that these fintech companies bring into the system. They will definitely be with strict competition that they will face from the private bank. So fintech is where I would be very careful. But in other businesses, wherever market leadership has been established, you should look to invest in. Valuations have come down for many of these companies, and also the promoters of these companies have started talking the talk which public market investors like, which is a path to profitability and investing in businesses, but being very careful about how they burn the cash.
All right, Mr. Karwa, thanks so much, sir, for stopping by and giving us your view. Wishing you a good Friday, and look forward to chatting up with you rather soon. Well, for the markets, as we earlier stated, don't rush and buy the opening tick. Look for a bit of a dip. Now, the markets have come off considerably from the high point of the day. The Nifty is up only around 15 points as we speak, though the breadth of the market is good, and that's encouraging. So, the number of stocks advancing are still close around 3:1, so that's pretty good news. And the mid-cap index is up 0.8%. Small-cap index as well is doing fairly well. Well, let's move on then. We have Adani Wilmar. They saw a weakish performance in the edible segment in the second quarter. Well, the food business, however, looks pretty strong. To discuss where things stand now and get a sense about demand on ground, we're joined by Mr. Anshul Malik, the MD and CEO of the company. Good morning, Mr. Malik. Thanks so much for joining in. Well, first things first, I wanted to ask you about your exposure to rural India. We're getting mixed signs coming out of there. While majority suggests that rural India is still in pain, I think your exposure is around a third or thereabouts. Could you tell us what's your exposure to rural India? And also, if you could tell us, are you seeing decent offtake?
See, as far as rural India is concerned, we have seen some amount of dip in consumption. Particularly, we have seen that in edible oil. Not so much in staples I have seen, but in edible oil, 40% share comes from towns which are 1 lakh or below. That has come down to 37, 38%. So around 2% dip in that segment. But in foods, we continue at around 25% share in the rural market still. So that, I think, is still a healthy sign going forward. Now, normally we have seen Q2 and is not at all a good for rural. Q3 onwards, it starts picking up after the harvest. Now, this year the harvest was delayed, and November onwards, the crop has started coming to the market, you have seen. And we also feel that money has started coming into the hand of the farmers. And December onwards, we will see good sign of growth. January onwards, the real thing starts. So Q4 of this year and Q1 of next year should be a big year, because agri crop has been good, let me tell you. And the remuneration on the farm output has also been good. Basmati rice, you see, rice prices are around 15-20% higher than last year. Wheat is also good, so sowing is good. Mustard is good because remunerations, returns are much better. So overall, agri business looks better.
Malik, although the agri business looks better, just a little more details on the dip that you've seen in the consumption of edible oils. By the end of the year, what kind of growth do you see in volumes for edible oils? And currently, a little under 20% market share. Where do you see it in the next 1 year?
See, the dip that we have seen in the first quarter and second quarter, not so much on volume, but on the prices. And now going forward, these prices are very comfortable and consumption has started. We are seeing good consumption for the marriage season. And this year, as you all know, the number of marriages are much higher, and base consumption on marriages in food is almost 30 to 40% comes from grocery. So we see great opportunity for our basmati rice and edible oils. Going forward, if you see the consumption is going to be better. We have seen in edible oil at least from dip of last year to increase of around 8 to 10%. And as a company, I feel we will do much stronger than what we have done earlier.
Sorry, what is that 8 to 10%, Mr. Malik? Good morning.
Which one?
The 8 to 10% that you mentioned, that is an improvement that you expect.
These are all volume growth that we talk of, not value, because value-wise, market is not in our control. But volume, surely we are strong, and quarter 3 we will be at least 10 more than double-digit, surely, and stronger double-digit growth over last year.
Volume growth in edible oil.
Yes.
Okay, because food
business we have been growing steadily.
Got it. No, because Q2 volumes were about 1% lower year on year. You're saying Q3 volume should be 10%, at least 10%, if not more. And Q4 and Q1 of 24 will be even better. I mean, that's when the real kicker will start to come in, is what you're saying. What's the split right now between edible oil and the foods business for you?
See, the food business has been growing steadily at around 40%. Last year, on a value basis, it was around 6%. This year, I think it should be around in the range of around 8 to 9% at least. And overall, food business should be for 4,000 crores plus.
All right, Mr. Malik, input costs have cooled off. So could you tell us, what is the cool off for your raw material basket? And will that flow through to the margin perspective? Because, I don't know whether you're passing it on to the consumers, but give us a sense on that front. Will margins improve from here?
So between Q2 and Q3, surely the margin pressures are much lower, honestly. Q2, we had a margin pressure because we wanted to hold on to the market share, which we feel is primary importance for the organization. But Q3, the margin pressures are low because the commodity prices are low. And as you know, brands always do well when the commodity prices are low. And we have to reduce the price at that speed. And we are comfortably placed this quarter.
But you're not giving us the numbers, sir. Your raw material basket has cooled off by how much? If I compare quarter 3 to quarter 2, there is some relief, which is good news for you. But how much of it will it flow through in terms of your margins? And are you passing that on?
See, in edible oil, the prices have come down, that you are all aware. And that surely we have to pass on to the consumers to remain in the market and push our volumes. But the margin pressures are surely much lower.
Okay. Any acquisitions on the cards? I mean, you've spoken about that in the past as well, but anything in the next 6 months?
See, it's a continuous evaluation that we keep on doing, and we keep seeing stretched assets, organization or brands. Now, all of these three we continuously do. Valuations also has to meet our strategy and how we want to place it. I find stretched assets as a better buy instead of buying companies and all that, because we already have strong brand Fortune, Kohinoor, and our other brands like Kings and other. So, and we have a distribution network across the country. What we need is assets to ramp up production fast. So that we are looking at more closely, and I'm sure we will be working out on these things fast.
Okay, when you say fast, any timelines that you're looking at in this fiscal year itself? And you spoke about stressed assets, but any segments that you're looking at particularly?
See, we are in staples. So anything in staples, we are surely looking at stressed assets, whether it is rice, wheat, flour, edible oil, mustard oil, and all that. So surely we are on that. We are also looking at any assets which are value-added products coming out from the basic staples. So that also we are looking at. So looking at all these things is a continuous affair and cannot say exactly what timeline. It can happen soon, it can happen a little later, but there are surely some discussions going on and several stages are there. So we are seeing that.
You want to give us the, how large an acquisition you could be looking at, the potential money that you all will allocate for inorganic growth?
See, in our IPO, we have said around 500 crores has been set aside for acquisition, and we have put around 1,900 crores for capex. I can tell you the capex will be more than 1900 crores, and we will put more money from our internal accruals. As far as asset or brand or anything that we want to acquire, 500 crores may not be all that fully enough to buy. So we will put in more money if required, and we have no issues on that.
Okay, Mr. Malik, I want two numbers from you. You're saying the 1900 crore capex has an upside. So what could it be in terms of the capex? How much are you going to spend? And also earlier you said that edible oil prices have corrected and you're passing some part of that on. What has been the price correction between Q3 to Q2?
See, it in different oil has different price corrections. In case of palm, you can see the price corrections are in the range of around 10-15%. In soybean oil, we have seen around 10%. Sunflower oil, not so much, but yes, we expect 10%. But somehow sunflower oil prices are still holding on because of the tensions there in Ukraine and Russia. Overall, that has been the price dip. We have been able to pass on and still retain some for our bottom line.
Okay. And capex, you were saying you have upped it?
Capex is 1900. We have already assigned, and I think another 50% surely will go up.
Okay. Just one final question. The food and FMCG volumes were very good this time, about 41% growth in Q2. By the end of the year, where do you expect to see that growth?
See, two businesses that we all are paying attention. One is food and staples. So we are growing at around 40%, and I am sure we will ramp up production and business and sales and distribution to continue with this growth year on year. Second business is our oleochemical business. Let me tell you, our oleochemical business is a very strong business. We almost supply 32% of the stearic acid in the country. We produce almost 28-30% glycerin for the country, both pharma grade and industrial grade. We also produce 10% of the soap noodles of the country requirement of around 1 million tons. We produce more than 100,000 tons. So we are a reasonably strong oleochemical player. Going forward, we have plans to invest in it because oleochemical is a very profitable business. Plus, it has a lot of synergy with our palm oil and edible oil business. So we have complete back-to-back integration in this business. And Wilmar, as you know, is the world's largest oleochemical player. So we have tremendous inner strength in terms of technology, knowledge of the business, and the overall distribution and sales of this business. Let me tell you, our soap brand, Alive, is now almost 100 crore brand. This year we will cross 100 crore. So a small toilet soap brand that we started as a ancillary, and now it is now getting into that 100 crore bracket.
All right, Mr. Malik, we leave it at that. All the best with all your brands as well as the business. That's Adani Wilmar, but we have to point out HCL Tech, which is taking a huge knock this morning, 5.5% lower. And as we were telling you, it's mid-quarter that the company has gone ahead and scaled down its guidance at a time when they raised their guidance just in Q2. So this has come as a deep disappointment for investors, and it's having a rub-off impact on the rest of the pack as well. So Infosys, TCS are all down about 5.5%. We'll get to Rima in just a bit. But these are two stocks, right? I mean, there's HCL Tech on one hand and there's Paytm, refused to get out of the news.
By the way, Paytm is also off sharply
yes.
From the day's high. I think, 545 or so was the high. We're at about 530. You know, what I basically thought to do is, because there are so many varied views, right? Some very critical, some very generous. I just decided to put out 4 points, 2 critical and 2 generous. I mean, if you... it's pretty easy to look through the loopholes in terms of why this is a bad idea or why this should not be done. So let's just start with the critical view on Paytm. 2 points, right? One, of course, the number one is it basically reflects the lack of growth opportunities in a business. I mean, if you think that there is significant growth, why would you return sort of money to shareholders, capital to shareholders? Why would you buy the stock back? You'd use it to better use. Number two, and of course, this is something which we heard around the time of the Nykaa issue as well, that, you know, too much focus on the stock price and not so much on business. I mean, you know, you can argue maybe on the latter, but perhaps excessive focus on the stock is something which was criticized at the time of Nykaa as well. So it's pretty straightforward. I mean, the loopholes are the critical aspects that you would want to talk about. The generous view, and I think this is where, again, there's a fair bit of debate. Is it possible? But, we'll only, of course, know the answer by putting this to the Paytm management. And this is a valid question, must be asked. Are they, by doing this, saying that they're seeing the years of cash losses behind them? At the recent analyst meet, the Paytm management is on record saying that they will turn, cash positive by FY23, excluding, of course, the stock options. Basically, does this signal that they don't need to hold on to all this cash? But more importantly, they'll turn positive, and they will stay positive. It's not as if they will come back into the red anytime into the future, because, then you would need the cash, right, to support. So is this a signal? Is it a signal in that sense? And of course, the second one is you've got tons of angry shareholders after what the debacle that the Paytm IPO has been. So it's a move to placate those shareholders. It's, of course, a signaling impact as well that the management has confidence in the business prospects, etc. So I just thought I'll put both sides of the equation out. Broadly speaking, this will lend some support, but there are two things to note. One is there are still lots of pre-IPO investors like Alibaba, etc., even after the block deals we've seen in Paytm, who may come and sell, right, in the over the next many months. That is number one. So that selling pressure is not completely gone. And the second more fundamental point is that buybacks, bonuses, etc., they can support for some time. They can provide support in the near term. But at the end of the day, you got to go with business fundamentals and whether the company is going to make money on a sustainable basis. And I think there are more questions than firm answers at this point in time. So that's Paytm for you. Thought, just a quick comment would help viewers. 529 on Paytm, off the highs by quite a bit. Sonia.
Absolutely. They could have just used that cash perhaps for growth, right, rather than for the buyback. That is the argument in the market and perhaps a disappointment there as well. Let's see more details expected at the board meeting on the 13th of December. And of course, this is a sheer attempt by the company to at least provide some support for the stock price. So let's see how that shapes up. But Rima's with us to tell us about HCL Tech. It's down almost 5.5% right now. Rima, over to you.
Thanks so much for that. So HCL Tech CEO in a late night US analyst day has said that growth this year, FY23, is going to be at the lower end of their guided band of 13.5% to 14.5%. Remember, the company had revised their guidance just 2 months ago in middle of October. So 2 months down, they felt the need to come out and categorically say that the growth will be at the lower end of the guidance. So the question is, what changed in the last 2 months? What we understand is a higher than expected impact of furloughs and some discretionary cuts in verticals, maybe a little bit of BFSI and telecom. Telecom vertical, that appears to be a new, vertical which has been added to, the list of sectors where we are seeing some amount of caution. That's the reason given by the management. Furloughs impact discretionary cuts in some verticals like telcos was higher than what the company had anticipated. That said, they said the deal booking is fairly healthy in the second half. The pipeline as well is healthy, but the fact that the company felt the need to come out and revise, say that growth is going to be at the lower end of the guidance just 2 months after they had revised it has disappointed the street. And this is a big company with revenues of, $12 billion roughly on an annual basis. So this is going to have a ripple effect on the rest of the IT pack as well in terms of sentiment. Back to you.
Okay, well, thanks a lot, Rima, for that. It's having a rub-off impact on the other IT stocks as well. Let's slip into a quick break. On the other side of the break, we will connect with Jagannathan Chakravarti of Sonata Software to discuss their business outlook. We'll also be joined by Vinod Agarwal of Volvo Eicher CV to discuss an update on the commercial vehicle business. Stay tuned.
CNBC-TV18, celebrating 23 years of business leadership.